Hi, and welcome to the Grove Podcast. I'm Matt Battiali, your host. In these episodes, we try and bring you companies and people and discussions that we at Mangrove Investor feel are important. These are the parts of the business world that maybe you don't see every day. So we try and highlight nonprofits, private companies, and even some public companies, and show you the good that they're doing. So sit back and enjoy this episode, and thanks very much for listening. Hi, I'm Matt Battiali from Mangrove Investor. Hey, make sure you like and subscribe to our channel to get great investment ideas that have a sustainability angle to them. But today, I want to tell you a little bit about the booms and the busts in the stock market. Because if you don't understand cycles, stocks can cost you a lot of money. My uncle is a great example. Now, don't get me wrong, I love my uncle, but he's a classic duffer when it comes to the stock market. Back in the late 90s, his house flooded and he got a check from the insurance company, and he decided to put it to work in the stock market. He asked around and his friends told him to buy Disney. Now, that was a sensible argument at the time because Disney shares soared throughout the 90s. The company partnered with Pixar to put out some classic films like Toy Story, The Lion King, and Beauty and the Beast. Disney's shares soared from around $7.50 each to peak around $35. The problem is the success was in the rearview mirror. By the end of the 1990s, Disney began to struggle, as you can see in this chart. From 2000 to 2002, shares fell by 60%. Now, this was due to a combination of the market crash in 2000, struggling box office results, and poor management of the company. Because my uncle didn't understand cycles and had no exit strategy other than hope, he lost a lot of money, and he finally sold in disgust. Then Disney went on to do this. Timing, as they say, is everything. Every sector has some cyclicality to it, but resource markets are the absolute worst or best if you understand how they work. As my friend Rick Rule likes to say, you're either a contrarian or a victim. And what he means is you have to steel yourself to buy when the cycle is low and get out when the cycle gets hot. This makes sense until you're in the moment, and then it's particularly difficult. My uncle did the exact opposite. He bought a hot stock that all of his friends knew because shares had gone up forever, and then he waited until those shares cut him in half before he sold. We see the opposite situation today. While shares of the S&P 500 are down more than 11% in the past year, and the NASDAQ is down more than 22%, the TSX Venture Index, the Dow Jones Industrial Average of junior mining stocks, is down 40%. Companies can't raise money, investors are dumping shares into the year end to write off their losses on their taxes, and it feels like the end of the world. But if you understand the cyclical nature of the stock market, you should be getting excited because the shares that we want to own get cheaper every day. So here's what you should do. Make a list of your favorite stocks and get ready to start buying because this is what the bottom of a cycle feels like. Thanks for watching. I'm Matt Battiali from Mangrove Investor. Hey, be sure to like and subscribe for more stories like this one. Well, look at that. You made it to the end. Thanks very much for listening. I hope you enjoyed the podcast, and we're going to have a lot more coming. You need to sign up and become part of the Grove. Give us your email address, and we'll make sure you're notified anytime there's a new podcast coming down the pipe. Have a great day.